Talk is on 29th November, 2 weeks from now, and the speaker will be Dr. Dale Klein. Dale is the Associate Director for the Energy Institute, Associate Vice President for Research at UT Austin, and he was the former chair of the Nuclear Regulatory Commission. A big-time expert, a big name, and he'll talk to us on the road forward for nuclear in the U.S. and internationally. Our speaker today is Alan Goodrich. Alan is a senior analyst at the National Renewable Energy Laboratory. His expertise in economic analysis in support of R&D management and business development decisions. Alan joined NREL in 2009 and serves as the lead analyst for the solar PV cost analysis team there. His team provides critical analytical support to strategic R&D decisions facing the DOE, NREL, and industry partners. Some of the focus areas of his team include solar PV module manufacturing costs, cost of installed solar PV systems, and materials resource availability. Alan holds a bachelor's degree in industrial and management engineering from Rensselaer Polytechnic Institute and an MBA from the University of Colorado at Boulder. He will talk to us on building and maintaining competitive advantage in clean manufacturing. I think a lot of that will be around the solar manufacturing industry. Please join me in welcoming Alan.
Thanks. All right. Thank you, Varun, for the introduction, and I appreciate everyone having me today. I really enjoy these opportunities to interact with folks from a lot of different fields, and when you go to a university campus, it's usually what you get. We spend a lot of time looking at the costs of manufacturing these products, and there are a lot of higher level questions to explore around topics like competitiveness, and we explored some of them this afternoon. So some folks got to hear me talk before this, so hope I don't cover too much of the same topics in this presentation. I'll spend about 20 minutes, I guess, going through the slides and talking about the work that we've done and some of our conclusions, and hopefully plant a few seeds so we can have a good conversation afterwards. I'd like to first start by acknowledging the folks that have contributed to this work. People at NREL, my colleagues Ted James, Michael Woodhouse, and then our collaborators at MIT in the photovoltaics laboratory there, Tonio Buenasisi and Doug Powell. All right, so are many folks familiar with what's been going on in solar recently? It's been described as a bit of a bloodbath, at least from a manufacturer's perspective. It's a great time to be buying solar. It's a bad time to be selling it. The cost trajectory of this technology continues to just outpace all forecasts and projections with a few bumps along the road. One of the elements that's been driving this that no one has really teased out has been the rise of the Chinese manufacturers and the low-cost manufacturers, and we'll talk a bit about that. But one of the characteristics of any industry are these dramatic shifts in supplier and buyer power. Right now we're in a bit of a trough in terms of demand. So a lot of the prices out there that you see are not necessarily sustainable, and we think they may bounce back. And so when we're forecasting technology costs at NREL, we look at not only the manufacturing costs of the product, because that doesn't tell us what the LCOE is and how it competes, but we also want to forecast what the price of the product could be at that cost structure. So we calculate what we call minimum sustainable price. So we effectively assume a market at equilibrium, and we'll talk a bit about that and how it relates to our competitiveness analysis. So we try to ignore all the noise that's going on in the nascent industry. But another feature, besides the costs coming down, and here's the learning curve, here's the bump in polysilicon price, and we didn't have enough suppliers, is the rise of China as a point of origin for these products, and basically from everything from polysilicon all the way through to the end of the module. We'll talk about those other activities. If you look at how the other countries have grown, Europe, which is a large deployer of PV, has not grown nearly as much. China, which doesn't deploy very much PV, is basically doing it for export. We basically want to understand what's driving this. And this grew kind of organically out of our work. As I was saying earlier to some folks when we were chatting before the presentation, my focus was never on competitiveness. We were trying to inform R&D strategy decisions. So we build these elaborate spreadsheets with a lot of granularity, and we try to say which levers can we pull to reduce the cost of PV. We have limited resources at NREL and at most institutions that are investing in research in PV. Where should we focus them to lower cost? Well, you build a spreadsheet and you want to check it against what's being reported. So we go out and look at some of the publicly traded companies, and we find that most of them are not located in the U.S. We're interested in reducing U.S. manufacturing costs from a DOE investment perspective. So we have to normalize our model and say, what do these costs look like if we change our spreadsheet over to be a Malaysia manufacturer, a China manufacturer, a Japanese manufacturer, Korean, Germany, et cetera. And we find it's a lot more complex than labor rate, and we'll talk about some of the inputs that we must consider. When we did that, we found that a lot of what is driving the difference in cost between the different regions and the rise of certain regions is not indigenous to a particular location. It has a lot more to do with policy and government interventions and other features like that. And that became very interesting because DOE would like to see more broad-based economic return for its R&D activities. If manufacturing can result from them domestically, that's a great thing to point to. Maybe they can think more strategically about what types of technologies can be manufactured here, in addition to just reducing the costs for solar. All right, so as I was saying, if you look at how much we produce versus how much we install, we're at almost a 45-degree angle in the U.S. So we basically, until most recently, have produced about as much as we deploy. Whereas if you look at China, they're basically exporting, or have been historically, exporting about 85 or 90% of what they produce. And Europe has been buying an awful lot of imports. So this is a basic depiction of some of the trade flows, but what we can basically say from this is the rise of China production has not been for Chinese deployment, so it's been for export opportunities. Another seed I'd like to plant before we get into the weeds of our analysis, and we were chatting a bit about this earlier, so the objectives of DOE and of NREL and our government objectives for solar research relate to deployment and reducing cost. And so from one perspective, having products made in a low-cost region meets that objective. It's helping us to lower the cost of solar, which is helping us to deploy more solar, which is a good thing, every way that you measure it, greenhouse gas reduction, et cetera. This is an analysis that was done by my colleagues at NREL for the Solar Vision Study, where we looked at a variety of system cost scenarios and said, how much would we deploy in the U.S. at different price points? And they model both the utility and distributed sectors. What we find is that if we want to achieve significant amounts of electricity from PV, so in Ohio, in Vermont, in Kentucky, as well as in those transitional markets like Hawaii and California, we really need to get down to about $1 a watt for the system price. In most locations, that would make PV affordable and competitive without subsidy, and that's chiefly what's going to drive widespread deployment, short of any other policy actions. So the main objective is to deploy solar, and the best pathway to that objective we find is to lower cost. What we also conclude is that it takes significant cost reduction even at today's lower prices to hit some of these targets. So I think utility scale systems, some of them are pricing at $2 a watt. Residential systems are pricing less than $4 a watt today. We think that utility scale has to get close to $1, and residential has to get below 2 in order to have the kind of deployment that we're talking about, where you hit that 18 to 20% penetration level in the U.S. That's a big challenge. So innovation is definitely still, further innovation is required. So when we look at the manufacturing supply chain for crystalline silicon PV, we look at modeling the costs at each of the activities. So you start with the polysilicon feedstock, and then you have the wafers and the cells and the modules. And what we basically do is we try to assess what are the technologies that are being used to manufacture these products in China versus Malaysia versus the US, and we collect all the equipment prices, and we model the cost. We have a standard technology that we consider in this analysis, and then we also look at what are our pathways to those lower price points that we were just mentioning. So those are the two scenarios. How are we going to manufacture today's product, and how do the cost results from that analysis explain what has occurred? And then the second scenario, forward-looking, is if we have a high technology product, all that contact cells, super thin wafer, high efficiency, everything goes right, could that change the results of our analysis and what we expect the supply chain to look like in the future? I won't bore you with a lot of stuff like this because I want to get into the meat of the analysis, but it's costs according to GAAP. We consider all the cash and non-cash expenses. We also look at the cost of capital for the firm, which I'll go into. So at each one of these steps, we're adding up all these inputs, and we're saying, yeah, labor is different, but the prices of the materials could be different, the price of the equipment could be different, building the factory can be different. So we establish costs, and we find that today the cost of making the module, doing all the activities in the US, is a little less than $1, and the cost of doing all those activities in China would be right around 70 cents. Then you have shipping to the US if that was where your end market is. And then we look at these other scenarios that we'll get into with the high technology case. But as one manufacturer put it to me when we first started doing this analysis, if it was all upside to move to a low-cost labor region, then there would be no manufacturing in places like the US and Germany. Everyone would go to places like China to do these products, and that's not the case. So I felt like when we started doing this that we were missing some piece of the picture also. So we started talking to firms that are going there or that are there or are going to Malaysia and other places, and we're asking them about these factory location decisions, and then we started trying to emulate those decisions. And some of the factors that they included, so we know there's low-cost labor in some of these regions of the world. Along with that low-cost labor, we find that there can be higher inflation, wage rate inflation in China, for example. Last year, Suntech told us that their wages increased by 50% in 1 year, which is a pretty good raise. It's better than we get at national laboratories. So you have that to contend with, but that's also part of the reason why these clean tech, biotech, high technology sectors are so sought after in some of these locations. You have wage rate inflation with a fastly growing economy. You want jobs that provide wage rates that can keep up with that pace of inflation. So you'd like to transition manufacturing from low-tech, high labor content products into more skilled industries. And there's definitely been a concerted push. There's plenty of documents in the 5-year plan that point to those industries that they're targeting. So you have inflation to consider. So if I'm a company looking at making a factory location decision, that's one of the factors. There's preferential tax treatment we'll talk a little bit about. There are supply-side subsidies in the form of free factory space and low-cost land use rights. Low-cost capital is the key one that I'm now finding in our analysis of lithium-ion batteries and wind manufacturing as a common denominator. And if you go back and do some historical analysis on things like semiconductors in the 80s, when we were talking about Japan instead of China, low-cost capital was cited there also. It keeps popping up. I think it's an opportunity to do some further research. What do we mean by low-cost capital? Low-cost capital allows you to build these really big factories. You can go out and raise capital to buy factories that people have never seen the scale of PV manufacturing the way it's being done in some of these places. Scale has benefits, economies of scale, and then leverage over suppliers. So these are the factors we're trying to model. And a lot of the things like inflation and taxes require us to take our perspective on costs and then run it through a discounted cash flow. But then what's our discount rate? So then we get into what is the cost of capital. Well, we're lucky enough to find some debt deals that Bloomberg New Energy Finance reported in China. So if you look at the blue dots, those are Chinese manufacturers, and the rate on the debt that they received to build manufacturing plants. And you can see around the time we had a stimulus, they also had a stimulus just before us. And in 2008, there were companies receiving, in real terms, negative interest loans to build factories, which is a really good deal, unless you're the bank. We have some that are approaching that, some of these red dots, and even below that, but I think the scale of these loans, I think it was like, when we summed this up, it was like $3.2 billion worth of loans made to PV manufacturers in China versus like $1.7 billion in the US or something like that. So it's about double. But if I'm a company and I'm considering building a factory in China or Malaysia, there are other things that enter into the equation that we broadly characterize as country risk, but that include my assessment of things like the rule of law, corruption, inflation, we mentioned, stability of the economy, potential for business interruption. There's many factors to try to quantify, which are very difficult to add up. So our take on it was to look at the performance of 3 of the top Chinese publicly traded firms and a couple of the top US publicly traded firms. And we looked at their stock equity betas over time. So over a 5-year period, we looked at how those stocks performed, and you can see the blue lines are much more erratic than the red lines, and the black line is the actual market. It's the global all-country world index. So you can see PV in general has a lot more volatility than the world market, but the Chinese companies have even more volatility. And if we normalize for differences in leverage, and we are comparing companies in the same sector, then I would submit the reason we see unlevered betas for the Chinese companies that are higher than the unlevered betas for the US firms represents some assessment by global equity investors for country risk. In other words, I'm saying for the same return, I would only invest in China if there were a lower risk. Or a better way to say it is, if I'm going to invest in a Chinese solar company as a global equity investor, and I can invest in solar companies all over the world to take advantage of that growing sector, I'm going to want a bit of a higher return in a developing country versus a developed one. And this gets to kind of the global equity investor's perspective. Another reason I would say that there is some higher risk there, you can point to some of the strategy decisions by Chinese PV companies, and they're not necessarily, they don't appear to be necessarily in the best interest of the shareholders. So we have, in 2012, all these companies are reporting negative margins. There's vast oversupply in the industry, and you have, I'd have to count them, I think there's like, I have listed here, something like 12 Chinese companies that have reported to their shareholders that they're going to add more than 500 megawatts of capacity this year. Which, as a shareholder, I'd be like, why are you doing that? You're at 60% utilization and you're building more factories. This doesn't seem in line with my objectives. So there's some other evidence that supports this notion of country risk and almost an agency problem. So you have the government making the loans, and 98% of the loans in China are made by domestic banks or government-controlled banks. There's some sense that they have some control in the boardroom over how the company makes strategic decisions going forward after they've made those loans. So we use this information to calculate a cost of capital, which factors in the equity market risk and the low-cost debt and the low taxes, and we get different discount rates. And essentially we have a cost of equity from a global equity perspective that's about double in China, which results in a cost of capital that's about 50% higher. So in other words, if I'm going to build my factory in a low-cost labor region, I may require a higher margin. And this is sort of intuitive too, right? China's not the lowest cost labor place in the world anymore. Their wages are rising very high. There's been plenty of articles in the New York Times and other places that have talked about this. So in order for me to, if I really wanted to chase low-cost labor, I would build my factory in a place like, I don't know, Bangladesh or any place that has lower cost labor, right? So that's not the chief reason. If I go to a low cost labor location, I may require higher returns too. These are some of our assumptions about the wage rates and some of the other factories. We make an assumption that in a low-cost labor region, you would have less automation, so the factory is cheaper to build. What we're basically doing in our long-term perspective is we're saying sort of bookends here on the outer columns. Those are today's numbers. And then as the industry matures to maybe 10 times the demand that we see today, it's very hard to keep up the same level of government support for these industries, for these sectors. So we would see, and we actually have already seen this, the tax holidays being reduced, the amount of debt being provided to the companies by the government is being reduced. So we're moving towards a level playing field already. So that's our long-term scenario, kind of market equilibrium, long-run scenario, if you will. Let me flip to this slide. So we looked at wafers, cells, and modules, and essentially what we find, the indigenous factors, factors that are indigenous to the region. So we start with the US bar, wafers, cells, modules, and our margin. And what we find is labor has very little to do with these products. They're very high throughput, highly automated. There's just not a lot of labor in making solar products anymore. What advantage there is for low-cost labor can be offset by a bit of a higher inflation and a bit of country risk. So the country risk we just discussed and all that work only results in 3 pennies, but it was fun to do the work, I guess. And then there are regional incentives to include. So you have the things that I mentioned, like the provincial subsidies and the tax holidays and the cost of debt. And actually, this is interesting because the low-cost debt that I showed, it doesn't appear to be that significant at all in our discounted cash flow model. Doesn't have much of an impact. But what I would say is it has enabled the most significant advantage, which is scale. And here we quantify the scale advantage based on the economy of scale for the factory, the leverage over material suppliers, and the leverage over equipment vendors. So we know that equipment in China can be up to 90% cheaper. We know that material suppliers get about a 10% better price because of the leverage that they have for being at 4 times the scale of a US company. So having access to low-cost capital to build these very big factories, they've now created a supply chain, a clustering kind of benefit, if you will. So having a 2 gigawatt factory attracts the material vendors to co-locate in the region, and now they're next door, and then a guy at the factory says, I think I have a better way to do this process, and he spins off and does his own equipment company. So there's some real advantages there now that they've basically created, I think, by growing this industry to the scale that it is today. When we look forward to the high technology case, you know what? On a relative basis, it doesn't change that much. Innovation doesn't solve the problem for us. But the thesis that we put forward in the write-up of this is that essentially what's limiting the US companies from achieving the same level of scale is the market risk. So if I go and I want to build a PV factory and I go to my investors, I want to go public with my firm, they say, oh, that's great, you're going to sell products as long as Germany has a feed-in tariff. And I don't know how long that's going to take, it's going to last. And you're selling products to 50 different states and they all have different, there's a lot of regulatory risk here. So I'm recognizing there's a higher market risk for this investment. But if we could lower the cost the way that we talked about to get to that competitive price point, that sunshot goal that we mentioned at the beginning of the slides, so that you could be competitive in most locations, not just the transitional markets, but in most locations without the need for subsidy, then you would have no problem raising money to build a factory. If you truly had a 50 cent per watt module at 20% efficiency, I think you'd be able to build a 2 gigawatt factory without much problem. So in that case, if we assume that, if we level the scale advantage and we assume the same cost of capital, then with the inflation and some of the country risk issues that we talked about, we actually find that activities like cell manufacturing are competitive in a place like the US. Things like wafering are still very difficult to highly automate, so there's a bit of a labor advantage there, which brings me back to another point. So I hope that when I give this talk, it doesn't sound like I'm one of these guys that's arguing just for manufacturing's sake. I strongly believe that, things should be outsourced. There's an efficiency in doing so. It's beneficial to our economy. In fact, a lot of manufacturers in the U.S. benefit from having products that they use in their products built offshore. It makes them more competitive. But when I see things being offshored for reasons other than what we call indigenous, when governments intervene to build an industry or to move an industry offshore, then I would submit that that's probably suboptimal. And so there are pieces of this supply chain that will likely go offshore, and then there are pieces of this supply chain that we have a shot at being competitive in. And so I guess that's our conclusions. Of course, there's Mexico, which is also low cost, and we can avoid the shipping costs. So we did an analysis around that too. So shipping costs don't necessarily bring all the manufacturing back to the U.S. This is another part of our paper. This is the summary that I just showed you. So to summarize, I guess going back to our first point, in the long run, we think that there is an opportunity to get today's wafer-based crystalline silicon technology to a point where it's competitive without subsidy. There are pathways that are known. It's just a matter of implementing them. And regionalization to date has not been due to indigenous reasons. There's no advantage necessarily in these countries other than the government interventions that we detail in our analysis and quantify. Low-cost capital, which comes up so much when we talk about the international competition for industries, is a really interesting topic, I think, to explore. I look forward to chatting about it with you guys during the question period. And our conclusions, when I see that 30% difference between the U.S. and China bar, I'm buoyed by the notion that a lot of it is not necessarily sustainable, that difference is due to these interventions that the Chinese government has already, for example, mentioned that they are growing a bit impatient with the PV industry. So there was the currency exchange issue with their major customer, Europe, that hurt a lot of the profits. There are many companies there that are suffering, going bankrupt, want to lay off workers. They're throwing out another incentive to that industry, which is now they're beginning to deploy PV domestically, which everyone expects is going to be a benefit to the domestic manufacturers. But I would still submit that I think patience will run its course at some point, and when we project PV to grow 10 times as large as the industry is today, I don't think that the level of subsidy you see today can continue. So with that, I think we can be competitive, and I look forward to discussing it with you all. Thanks.
We have a lot of time for discussion, and Eric will pass the mic around. I have a question to start with, actually. So what do you think, for the next 10 years, can we bring back any manufacturing, especially in C-silicon or even with thin films, given what the Chinese are doing, the scale that they have already achieved, and that even with the losses they are making, 60% capacity factors, still capacity additions, by 12 of them 500 megawatts each. So one, we can be competitive, but the reality of it, looking the next 10 years, what do you think that is going to be?
Or even the next 5 years. So the short-term prediction is it's very difficult to see how it's going to play out. So with the trade cases and everything going on in the PV sector, and now there's retaliatory trade issues. So we currently export a lot of polysilicon to China, but now the Chinese manufacturers, which comprise 80% of the world's crystalline silicon manufacturers, are saying, I would rather not buy from the U.S. polysilicon companies just because I'm afraid that there may be a retaliatory tariff put on that stuff, and it may be, it may go back and it may really sting. So it depends on what you mean by manufacturing. We may lose some polysilicon manufacturing in the near term as a result of some of those trade cases. If Europe follows through with its tariffs, it could really hurt some of the Chinese companies. When the U.S. put up its duties recently, I don't think that was that painful because we're not as big of a market as Europe. So there's a lot of unknowns in the short term of what's going to occur with all this stuff, and it's beyond what we try to analyze. But in the long run, I would say, yeah, we can be competitive, and shipping costs are actually a growing tent pole. As the cost of all this stuff comes down, the cost of shipping glass starts standing out like a sore thumb. So I think module manufacturing will definitely have here. And then the question becomes, what else can we capture? Polysilicon, we have a structural advantage in that we have low-cost hydroelectricity in this country, and we're really good at doing it. There's some really good companies here that do it. So maybe bookends on the supply chain. We have an opportunity in the next 10 years.
Before we go to the audience, one more question, Al, for you, which is on, do you see, so we have C-silicon, we have thin film, do you see a role for any third generation technologies to bridge the gap between the $4 install costs and $1 where we need to get there? And if so, is that where the US needs to focus and maybe build economies of scale on those clusters?
Oh, I think right now there's so much technology risk, which is another risk that the investors look at in this space. There's so much technology risk and so many unknown technology externalities playing out. I think we should have a broad-based portfolio. The third generation stuff I think is very exciting. There are a lot of interesting technologies that universities are working on, for example, that could really be game changers, but that are high risk. But yeah, I think it's way too soon to say that we should close the door on thin films or just focus on third generation. I think crystalline silicon, whenever anyone has said that crystalline silicon can't ultimately compete, it's shown that it really has legs, and so it really can't be discounted. So we can't ignore that either. I think it should be a broad-based technology portfolio for sure.
Hey, Alan. My question is about the story, why China has so much lower module cost. So you seem to attribute that story a lot to the economies of scale over there. So I'm wondering how much is related to the learning by doing or other factors related to the technology change in China.
Sure. So if I understand the question, the technology that we've seen scaled up there is arguably off the shelf. My co-authors really hated it when I tried to get that term into the paper. I think every manufacturer likes to distinguish what they're doing, but the wafer-based crystalline silicon technology of today, if you were to put that module or that cell next to the same technology from 10 years ago, it would look very similar. So they have scaled up basically the off-the-shelf stuff, and in that regard, there's no distinction between what they do and what many other companies were doing in the US or Germany or other places. So I think the only distinction is that it was done at such massive scale. So if you go back to the first chart that I showed of the growth of PV, I mean, it's amazing to think that in like 2006 there was no PV manufacturing in China, and here we are, and they have like 80% of the world's manufacturing. In like 5 years, they went from like 0 to 60 in like 2 seconds. I mean, blow the doors off those F1 cars. It was like ridiculously fast. So I think scale is the primary advantage, but prove me wrong. Do some other analysis that shows there are actually some folks at MIT that do a lot of work that we've been talking to. They do a lot of work doing interviews with companies in China, and there are other benefits of being there. There's just kind of a culture for lower cost manufacturing that they really like to cut the costs. There's at every level of management and production, everyone is looking for costs to cut on products. There's kind of a culture of it almost. So there are other factors that they're trying to discern, but principally I would say it was scale in our analysis.
You showed a little point there that said maybe the goal was 65 cents a watt at greater than, I believe it was 20% or 21% efficiency.
Right. That's a result from our roadmap. We can see a line of sight for crystalline silicon to that number.
So that's current without any sort of third generation technology? Would you say?
I don't know
or
if
do
it's
you think
third.
we can actually get
When
there
we
with
say
current?
third generation, and I can't find it, and I'm making everybody seasick trying to.
I'm just curious if you see us actually getting to that 21% without having any sort of technological.
Oh yeah, we're actually there today
changes.
for modules. SunPower sells 20 or 21% modules today.
Right.
So there's like
their price is so much higher than everybody else's.
yeah, they're at about $1 for cost now.
At cost. Okay.
And they have a target. They'd like to, geez, I can't quote it very well, but they'd like to get below $1 by next year. They're trying to accelerate their roadmap. A lot of pressure for everyone to get their costs down. So they're kind of starting at high efficiency and trying to get costs down, whereas I would say most of the big Chinese companies, the big players, are starting at a moderate efficiency and low cost and trying to get it up. But I think they all kind of converge at the same combination of cost and efficiency.
Yeah, I mean, I asked because I haven't really seen any differences in the crystalline silicon efficiency. The modules have grown in size, but the efficiency hasn't really changed, except for SunPower.
Yep.
Maybe Sanyo and Panasonic a little bit.
No, I agree. I agree. They haven't changed in a long time. They have just sucked all the cost they can out of it.
Right.
And we were actually talking a bit about the nature of innovation. Now that you have such massive scale in the industry, the nature of innovation kind of changes also. So the opportunity to implement some disruptive technology now that you have a 2 gigawatt factory becomes kind of difficult. You have some inertia there, yeah?
So if I understood your conclusion correctly, you're saying that America's role is we can innovate and bring down our costs to a sustainable level so that we're actually competing on, the price per watt, things like that. But if we innovate and reach that level, what's going to keep, countries like China from just copying and scaling up and then driving everyone out of business?
No, I think it's a global industry. What I would say is the optimal result is that there's global manufacturing. So if you think of the 2 U.S. firms that we talked about, SunPower and First Solar, and actually if we look at any company that has manufacturing in the U.S., they only have 10% of their production in the U.S. Whether they're headquartered here or have a plant here, only 10% of the capacity of all those firms is in the U.S. They go to wherever the lowest cost is, which includes some manufacturing in the U.S. If you look at China, if you have any manufacturing in China, whether a plant or a headquarters or whatever, somehow China, 99.2% of your capacity is in the U.S., which tells me they're making suboptimal decisions because there are lower cost places to be like Malaysia or just put your module plant in the U.S. to avoid shipping costs. So I envision that it will be more regional, the manufacturing, closer to where demand is. And I think the U.S. happens to have a lot of solar resources and a lot of electricity demand. And so I would say we should be able to manufacture stuff here, but I don't argue that we compete, meaning that there shouldn't be any manufacturing anywhere else, or we should have the most of it here. It should be global.
So you gave an average number for the United States, the 62 or 65% objective, but obviously if you're in the Southwest, you can get away with with higher prices.
Mm-hmm.
And so, I mean, can you map that out in terms of deployment? And you would assume it would be disproportionately. In fact, you probably hope that it's disproportionately in the Southwest and California and Texas.
Yep.
How does that change? I mean,
it's really interesting to look at that map that you're talking about, actually. And my colleague Robert Margolis has published this. There's an NREL technical report. I think they've updated it. So Robert Margolis and Sean Ong do this analysis. So it's a combination of solar resources and retail electricity prices and local incentives, and they do this interesting bar chart that shows, like, as you strip away some of these things, which states do you capture first as cost comes down? And it's interesting to see which states start lighting up first, like Connecticut, because they have really high electricity prices. It like beats Arizona. But you're right. But in order to capture that really high percentage to get a lot of electricity generation in the U.S., we need to be at a really low bar to get a lot of that map to turn the color. We would call those like transitional markets, I think.
Yeah.
He's been trying to ask a question too.
So the approach of building up cost and from components and different components of the cost to add up what you think the projected cost or even the current cost in high-tech markets is one that, you mentioned the 1980s debates about strategic trade policy or where this has gone in the 1990s. There's not a lot of literature that does this because you have to make kind of wild assumptions to understand the cost, because cost data is highly proprietary, and you don't really know the processes and whatever's going on. So I guess I'm curious. You went through in some detail one of the least significant cost contributors, which is the risk factor, which you tried to measure with these publicly stocked, the betas of publicly traded stocks, which is worth something, and I don't want to quibble about
like
that.
3 cents, right? Whatever.
But
all the other
question,
stuff is what's important,
all the other
right?
stuff is a huge black box, and the most significant one is, I guess I don't even have a sense for what you think is the mechanism for the economies of scale you're talking about. Like, people always say, oh, there are huge economies of scale in high-tech industry, but at the plant level, at the company level, where do they run out? How does it come together? Like, what's the model, and where's the money, where's the data coming from to calibrate to get to these quite specific cost estimates?
All right, so I don't generally do this. So when we, yep, exactly, spreadsheet time. There's coffee in the room, so I assume not everyone will nod off. So when we do this, we look at each individual step, and when we talk about, in this case, we're removing the polysilicate glass. We know what the process is for crystalline silicon. It's really well developed. And people visit these factories. NREL people visit these factories, even in China. We know what processes they're using. They're using the same equipment that the Germans are using because they're buying the equipment in Germany. The prices of the equipment might be different, but when we model it, we're looking at every little minutia piece of detail for this little bath, this furnace thing over here. It's actually a bath. But then we also, the challenge is like, what are the Chinese costs? And then that's, well, we use a local equipment vendor, and they don't export their equipment outside of China because of, they say, they took off bells and whistles related to safety, or there's IP issues, or export restrictions, or whatever. So the most difficult thing isn't establishing the cost of the technology, it's that, what's the cost there for the technology? And so we spent 2 years working with industry to validate all the little minutia details, and this was a 3-cent process. So we went through every single step in making it, and I would say the way that we validate it is we then present it to industry, and we say, these are what your costs are, and we go through that with them. So we feel like the models are really well validated because we've built them up from the bottoms up, and for crystalline silicon technology, that's actually pretty easy. Through the thin films, it's difficult. I mean, for the crystalline silicon technology, if you have a subscription to Photon International, they do market surveys on the equipment, and there's list prices. Those aren't the buy prices, but you can start building a cost model using that. So we're lucky in the fact that in this sector, most of the IP is pretty old. All the processes are well known. It really is a real standard technology for making a silicon PV module. And that's why they were so successful at scaling it up, because they were able to just go buy the equipment from Germany. They've started replicating the equipment in some of these places and getting the costs down, but it's basically the same exact process as everyone's been using. Does that make sense?
Well, sure, but so let's say they're using each piece of equipment in some step at its maximum capacity. So in order to scale up, they're just buying more copies of the same piece of equipment.
They are.
They're all operating at max capacity.
Yeah, once they hit about 2,000 wafers per hour, they start just going redundant. They don't go to the 4,000 wafer per hour tool.
Economies of scale that are done, right? Unless you somehow get a bulk discount price on buying these machines, which seems like a challenging thing to arrange. Right?
Yeah, you do. You get leverage over equipment and material suppliers. So as you scale up, you would have more leverage on the prices of the inputs. But when we, in our model, so we would say, do I have the cost volume curve already pulled up? Maybe I do. I don't know. It's a data table. So we would say, what is the size of the factory? How much output do I want? I want 500 megawatts of stuff. And then for each individual process step, I know how much the machine costs and how much it costs to install a machine. And I know what the throughput is. And I know what the downtime is and the yield is and all that stuff. So I know how many good parts I'm getting out of this machine. I know how many good parts I want to get out of the machine. And so if I tell it I need more parts than the machine will hold, it will calculate I need more machines. And so you're right, the economies of scale you hit at about 150 or 200 megawatts. The rest of the economies of scale are basically in leverage. Leverage over material and equipment vendors, which is not really modelable. It's just...
Cool. Actually, I have kind of an expansion on that one, just in the economies of scale. Do you have enough data to see where the learning curve cost reductions are coming from within firms, as opposed to new entrants or whatever? As the market scales up, how much of the cost curve reduction is due to one company getting better at what it's doing and streamlining in-house versus next generation plant material equipment that just happens to be cheaper across the board for anybody, and they can go buy it tomorrow and they get to benefit from that? I guess my personal or local concern is we have in San Antonio a new plant that's going in that was incentivized to be put there by the city of San Antonio, but to my knowledge they hadn't really done this before. And what is the likelihood of them being able to deliver on projected costs, given that they haven't done that?
So that's actually one of the benefits I didn't touch on in China that we hear a lot, is that it's much easier to build the factory. It's faster to build the factory. So the scale-up issue, we didn't talk about that. So we shouldn't discount the fact that they achieve such rapid scale, such massive scale so rapidly. That's really a feat. They went from nothing to everything very quickly. There's an error bar around these cost numbers. I should present them with an error bar. I keep saying that. I'm going to do that. But, and you see that in the reported cost numbers from all of the major companies in China. They all have their little, we did a little bit different thing here and something a little bit different there, but it's all generally the same, plus or minus 5 or 10%, We have not seen any product come out of China that represents something really new, innovative, and breakthrough. It's kind of been squeezing more out of the same process. There's the Pluto cell and the Panda cell and the everything else, but none of them are being done at production scale volumes. They're kind of just to say we have a high efficiency, but nothing's being done at high volume. So they've shown that they can really scale up something very fast, but they've also not yet demonstrated the ability to scale up something new or innovative, like take a new innovative process. In fact, a lot of the thin film technologies that were attempted in China fail. SIGs and many of those other technologies that are not so off the shelf. There's a lot of black magic that goes on with SIGs. Those things didn't go right. So I don't know if that answers your question, but
yeah, it just coming to terms with the amount of learning that all these companies have had, and if that can be expected to continue, or if it's maybe one-time gains, and I don't know.
Well, we touched on that a little bit in the paper. So we recognize that we need innovation for solar to achieve the deployment goals that we want. And so the question is, with all this regionalization, what's the impact going to be on innovation? And a lot of the innovation infrastructure in the U.S. would be underutilized if all the manufacturing went to China. We would feel like that geographic distance might limit our ability to innovate. But what we're also seeing is, for example, Hanwha, which is a Korean company, but they own Solar Fund in China. They located their R&D in California, and many of the Chinese companies, now that they've achieved massive scale, are just buying a startup if it has a cool technology. So it's changing the game. Now that they've hit such large market caps, they can just buy a technology. We'll see how they are at implementing it. Is there a question in the back?
Yeah, so I want to step back a little bit from that and point out one of the things you had on your last slide, sort of conclusions. You mentioned, if I'm right, you said reducing cost of capital through subsidies. You also said key market risk demand side subsidies, reducing
not reducing cost of capital through subsidies. I think there's one cost of capital, and it can't be monkeyed with unless you do something really restrictive to your economy. But
Okay, now that's what I wanted you to pull up again, is because I wasn't sure what you were saying. Reducing market risk with demand-side subsidies?
So by reducing market risks, so that is hitting a cost point that eliminates the need for demand-side subsidies, that reduces the market risk. I didn't say it well here.
Yeah, that's what I wanted to ask you about.
Right.
Yeah, no, okay, I just wanted you to clarify that. Thank you.
Yeah, the low-cost capital thing is actually a really interesting one because you see it come up again and again in all of these industries. I was reading a book by Laura Tyson, and it was called Who's Bashing Whom? And I was reading it, and I swear you could just globally replace the word semiconductor with photovoltaic and the word Japan with China, and it was like, wow, this is it. I could just copy this, get my report done. But low-cost capital was brought up again and again. It's really interesting because countries seem to use it routinely. But the idea, I think, that you can do that now, it's very difficult because we have a global equity market. I can invest in Germany, and Germans can invest in Thailand. I mean, there should be one return requirement for a given set of risk factors, but there's so many restrictions on, I think, the ability for Chinese citizens to invest outside the country and for private lenders to do business in China. 98% of the loans in China are still done by domestic companies or government-controlled banks. I don't know how long they can really sustain this. Any more questions?
Yes, I got a quick question over here.
Oh, yep.
So one thing that I kind of was thinking about while you're going through this, more on the, this is more about the technical parts, and kind of pulling back. If I was Austin Energy and my costs are all about peak demand, that's what I'm concerned about all day. And I can sell muni bonds for 2%, all day long, 2%. And then I've got this other firm that wants to build solar panels nearby. It seems like instead of a subsidy, it would be a subsidy for the company, but not really. Because Austin Energy, it's more like just a business transaction. But I guess the problem there is the municipality doesn't necessarily have the financing horsepower to take on, financing a big chunk of a company that big. But if you could have a bunch, maybe San Antonio, Austin, Houston, kind of work together, it seems like that would be a really good way that they could help themselves, because adding capacity is like the last thing those guys like to do.
Yeah.
Our electricity prices are so low, that is tricky. But it seems like you hit them at the right table and you gave them this presentation and you wore like a really nice suit. They might go for it, Not that yours isn't great, but like if you're a good enough salesman, you could kind of finagle that kind of
Yeah,
thing.
I'm not a grid integration expert, but folks at our lab are, and I will say that from what I understand, the idea of peak demand. So you're asking the utilities to give up revenue, right? So, and it's also transitory in that if you had a bunch of solar deployed, well, that speed bump you have in the afternoon would get pushed out into the evening, and then all of a sudden the value of all that PV you deployed would go way down. It's an interesting topic, but whenever I hear basing anything on like afternoon peak demand, I kind of I don't know if that's, because I don't know if it's like, you're not going to always have 22 cents per kilowatt hour in the afternoon. If you deployed a bunch of solar, it actually goes away really quickly, our models show. But that is the good part, you're right. But then the value, so does the utility keep giving the homeowner the 22 cents per kilowatt hour to offset?
So they get crushed.
Right, well, but then you go back to, now you have to compete with whatever the real number. So let's say it goes down to 10 cents per kilowatt hour, whatever the base rate is for the homeowner. Okay, so now you're just back to competing at the base rate. And it gets pushed down like really quickly in the models. That thing gets pushed out into the evening, if that makes sense.
So I apologize if you've addressed this already. I came in very late. NREL licensed a technology that promised to both reduce the cost of anti-reflective coating and increase the efficiency. It's a nano process. And
Black silicon?
yeah, licensed to a company in New Jersey.
Okay.
Do you know what I'm talking about? And is there?
I think it was black silicon, but
Yeah. What's the status?
I have no idea what the status is. Everybody who is a startup in the PV industry is hurting right now. So if I'm thinking of the one you're talking about, though, I think it was in Massachusetts, and I think it was a company that was trying to do like a solar thermal, solar photovoltaic hybrid. and I have not heard what the
Now,
status is.
this was a, typically a process of chemical vapor deposition is used
Yep.
in the anti-reflective coating, and those machines are pretty expensive. This was a liquid bath deposition that
Yep.
didn't produce as much silane and other toxics in
Yeah.
the byprocess. So cheaper, more efficient, less reflection, et cetera.
I don't know what the status of it is, but I did analysis on that, so I happen to know it. I could chat with you afterwards if you want. I could show you some of my stuff that I did on it, but I don't know what the status is. There's a couple other firms that were developing that black silicon too. But.
Thank you for the second chance. So, quick question. Do you think to achieve the cost target, we need to focus more on the supply side or demand side?
Man, that's such a loaded question. That's the last question, really?
For the future.
Yeah. We were talking about this before. I think we can say with reasonable confidence, unless there's some policy action that we don't all anticipate, that innovation is really required to bring the cost of solar down. So if the ITC goes away, demand goes away. We don't want that. So we want the cost of solar to go down to be more competitive. So there's some reason to focus on the supply side and focus on the technology. But then we were also talking about, it's become such a big industry. We need to leverage private capital. We need to attract big companies like the Dows and the Totals and these other big companies to invest their money. Dow having $1 billion invested in solar, that would be great. So in order to do that, you have to have some kind of market opportunity. So you need some supply pull. So I don't know what the right balance is. I'm not a policy expert, but there's definitely an argument to have both. And I think the number one thing, though, is innovation is still required. And the best way to promote innovation is to have open and free trade and to have a global, let companies make global decisions, not constrain them to being located in one place. And, that's the only key takeaway I find. I don't know about supply and demand side subsidies, which is the best. That's a loaded question for an NRELian to answer on film.
I guess I'll ask the last question.
Yeah.
Which is,
Softball, please.
can you talk a little bit about what type of R&D the firms in China are doing and what's going on in the universities there? I hope that's a softball question.
It's not that much of a softball question. I don't have that much. Any other hard questions? I don't have that much perspective on it. We hear a lot of things. We host folks from China at the lab, and I know scientists who have gone there and have toured beautiful facilities that have no people in them. There's a heck of a lot of patent activity going on in China, but those patents are not being filed outside of that country, so it might tell you that the value of those is not that great. I would say the most interesting thing that's going on is there are so many Chinese companies now that are investing in innovative companies in the U.S. I mean, it's really hard to find a startup in the U.S. and not find a linkage to like a Chinese private equity firm or a Chinese big player. So they've really increased that in the last couple of years, which tells you that they're keenly interested in innovation whenever the market returns for all these guys.
Thank you so much, Al.
Thanks.